Chances for the Fed to rate hikes this December has slammed down to zero. And with 5 months of a rate pause, this has so far always signaled the end of a rate hike cycle. When will we have a rate cut and what will this mean for the markets here and abroad? Let's discuss. My name is Dan Slim and welcome to another episode of Monday Market Outlook. It was a non-surprise when the BSP convened for its monetary board meeting last November 16, keeping rates steady at 6.5%. Remember that the BSP hinted on further rate hikes during this meeting due to forex concerns, but the latest results from US CPI numbers has caused the retracement of the US 10-year yields, which has also caused the dollar index to go down, thus stabilizing the peso at its current levels at 55.56 to end the week. Inflation rate expectations to end the year for the Philippines is at 4.4%. 4.4% is just 40 basis points away from our final inflation target of 4%. However, we have to take note of some key factors affecting inflation for November and December, as we have yet to see the effects of these three factors. First, we have wage increase, the power rate hike, and the transportation rate hike, which may have lag effects on inflation. But so far, rice supply has stabilized, which is great news considering food forms around 38% of our inflation basket. Also, oil prices have retreated to 4-month lows. Now, watch out for oil prices at this critical level, 73.92, as we may see WTI crude fall back to 67 support zone if this doesn't hold. Now, though we saw profit taking from the shorts last Friday that caused the jump in oil prices by 4.36%. Now, this week, we could see short sellers recommit and possibly push the futures down. But of course, we still have to be wary of geopolitical concerns, especially in the Middle East. Nevertheless, we look to be on track for our GDP growth target of 6 to 7%, but at least for the lower end of our GDP targets. If we look at the past 4 quarters, we tend to see strong numbers during this season. If we look at past years, we see the fourth quarter here, and here, typically strong. So hopefully we could see the same performance this year so that we can hit our target. So let's look at the PSEI charts. The PSEI notched another week of gains as it broke out of this trend line resistance at 61.90, which is also the 50 moving average resistance. Watch out for the 100-day moving average, which corresponds to this demand zone. Last time we hit this was on September 28 and we retraced. So it would be interesting to see how it reacts to these zones. Some stock highlights for this week. Those who are waiting to enter SEC, wait until we see some form of structure. At this point, it looks like we are again headed towards the support level at 27.65. So set an alert there. Set an alert there and see how it reacts to these levels. For DMC, some structure happening at the 911 level. We are currently at 925. Could be a good entry. Ease in slowly for DMC. With great earnings reports from their individual companies, we see our favorite conglomerate stocks with strong demand, AC and SM, both doing quite well this week. Congratulations if you were able to buy into these support zones, 600, 580. As mentioned, these are good entry levels. SM, also a good entry level at 800. JFC, as mentioned, congratulations if you were able to enter into this pullback here. Last week, we mentioned that this pullback could be a great opportunity to enter, as this would most likely be met with buy demand, given that it was able to bounce off of our support levels at 212 and 208. Watch for its reaction here at the 200 EMA resistance, but looks like, again, pullbacks possibly to 225 could be met with buy demand at this point. ARIT is back at our buy zone at 32. If you are planning to buy ARIT, now is a good time. Dividends has also been declared with ex-date November 30 and payment date on December 15. Now, good news as the dividend has increased to 55 cents. Now, look at previous dividend. This was 53 and this was 52. On to the global markets, the US markets continue to rally off of great CPI numbers. Core inflation in line with expectations at 4%, but it was the lower than expected inflation rate for both month-on-month and year-on-year that pumped up the markets, along with PPI numbers also significantly down month-on-month, coming in at negative 0.5% versus the 0.1 forecast. Retail sales also down. Initial jobless claims 231,000 versus the forecast of 219,000. Plus the industrial production month-on-month down significantly, negative 0.6% versus the 0.2% forecast. Convinced the markets that rate hikes may definitely be over. So this slammed the possibility of rate hike for the December Fed meeting to almost 0%. Well, it was actually 0%, but note that there was a 38.5% chance of a rate hike just a month ago. So why is December important? Because if the Fed holds rates steady this December, this will mark the 5th straight month that rates have remained steady. And historically, when rates remain steady for 5 months, this has always signaled the end of a rate hike cycle. So with this, the S&P 500 notched its third week of weekly gains as it had its best day last Tuesday since April this year. The index rose after the CPI and inflation report came supporting the soft landing narrative. As we continue to leave a very brief correction last October 27, the index is currently consolidating at the 4,500 zone. And as it stands, price action suggests further upside in the shortened trading week in the US markets, which will celebrate Thanksgiving this coming Friday. Now, let's go to the 15-minute charts. We can see the S&P 500 holding this support zone here at 44.87. It was able to hold the 4,500 support zone level here before the market made another move upwards. So we could potentially see a continuation of this rally here when the markets opened this week. Now let's take a look at Nvidia's chart. Nvidia's chart is very interesting because I think this is going to be a very important week, especially for the Nasdaq. Nvidia will report their earnings this Tuesday after the markets, and depending on the results, this single stock could move the markets in either direction. Now the implied movement for Nvidia this week is either a plus or minus depending on the earnings results and depending on their guidance moving forward. While it's consolidating at 492, next Tuesday could see Nvidia make a big move and the Nasdaq along with it. So see here, as I add the US 100 here into the Nasdaq chart, see how the two charts have behaved the same way since May of this year. Both charts are currently consolidating near their highs as they await potential news this week. So given the increased volumes next week due to the shortened trading week and Nvidia's earnings on Tuesday evening, this will have an outsized impact on the broader markets in the coming week. So we could potentially see, going back to the S&P 500, we could potentially see S&P 500 push to this gap fill level here at 45.67 if Nvidia comes out with a great earnings report. Let's take a look at where the current US economy is at. So we have inflation currently down to 3.2%. The target rate is 2%. At this current rate, the forecast is for the US to hit this 2% target by May or April next year. Currently, jobless claims are up. This is further confirmation that the labor market is starting to cool down. Hopefully, we can also expect the unemployment rate to start going up to further confirm this. Next, we have industrial production slowing down significantly. And with all these factors, we are starting to see the actual first signs of a recession. Now, earlier we mentioned the significance of rates staying at their levels for 5 months. Now, let's take a look at this chart. A 5-month pause historically has always signaled the end of a rate cycle. And every time this happens here, 11 or 14 times the economy enters into a recession. When will we get a rate cut? Current probability places this as early as May next year. Is this possible? Yes, it's possible. But what does it mean when the Fed cuts rates? No? This means that something already broke in the economy. Why do central banks cut rates? Monetary easing, when the economy is in such a bad state that central banks need to cut rates in order to spur economic activity. So, does this mean, if we are going to get a rate cut in May, does this mean that the US economy will be in a bad enough state that the Fed will need to cut rates by then? It looks like it may not be as early as May, but most analysts believe that this rate cut will definitely happen in 2024, with even the possibility of 3 to 4 rate cuts happening in 2024. That's actually quite aggressive. Now, what happens when the Fed cuts rates? Now, it turns out that on average, the market experiences a drawdown of 23%. And this drawdown happens after an average of around 195 days. But who knows, it could be just 60 days. We could find the bottom in just 60 days or probably even 400 days. The drawdown may not be 23%. It may just be 10%, right? But at this point, outlook for 2024 may be not so good. But as we mentioned, no, these averages can change depending on the economic numbers moving forward. Could we get a soft landing even? Yes, we can. Retail sales are still up. I mean, companies are still putting in good numbers so far. Are we going to see companies start putting up bad numbers by May of next year? I mean, who knows? But in the meantime, let's just enjoy the current S&P rally. And here's to a Santa Claus rally, hopefully to end the year. No? So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Thank you for tuning in. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.